If you invest in these 3 ETFs in 2023, you can go broke. Currently, the US stock market is performing well. Some of the growth stocks are even being termed as Magnificent 7. In such circumstances, people would assume and rush to invest in any of the currently performing ETFs. But here's the catch. In stock market tables can turn quickly, so you should do some analysis before investing in ETFs. Today, we're going to talk about 3 ETFs that you should avoid investing in this year. So, without further ado, let's begin. First of all, let's discuss the Invesco QQQ, since it carries a lot of hype due to its increased price. The phrase, "all that glitters is not gold," is true for this ETF. QQQ is known for its association with the Nasdaq Stock Exchange, employs a unique investment strategy. It selects its investments based on the available shares on Nasdaq. This strategy does sound simple and straightforward, but believe me, the reality is opposite. One of the primary concerns associated with QQQ is its concentrated holdings. In simpler terms, it's like putting most of your eggs in one basket. Let's understand it this way. If you invest most of your money in a couple of stocks, you will lose money if those companies get into trouble. And this is not good for your investment strategy. One should understand that QQ is gaining more success stories because of the rising prices of its stocks. These numbers do look beautiful on paper, but beginners should understand that QQQ is not a sustainable investment for the long as this ETF has potential risks. This ETF is just like a toy who is gaining popularity just because it is expensive, even if it is not improving its overall quality. Overall, we can say that the Invesco QQQ Trust may be a popular ETF, but it's not without its concerns, especially for beginners. The strategy of selecting stocks based on Nasdaq listings and holding a concentrated portfolio raises concerns for beginners in investing. It's crucial to carefully assess these factors when deciding if this ETF aligns with your investment goals. Ark Innovation, which is known by its ticker symbol ARKK, is an ETF that got popular in 2020 and made great progress in 2021 and also in 2022. Many investors were also excited about it in 2023. But as the saying goes, the only constant in life is change, and that applies to investments as well. We can say that ARKK is just like restaurant that wowed everyone with its menu in the initial years and took the lead. However, when the restaurant became a hotspot for everyone, it started to remove its best dishes from the menu. ARKK was the hotspot for investors looking to find innovation in their portfolios. But as we've learned, even the hottest spots can cool down. In 2023, one significant change have affected the ARKK's reputation. They have modified its lineup of investments, which can be a concern for those looking at the long-term picture. Now, ARKK works according to a term called turnover. It means that ETF buys and sells its stock quite often. This behavior might not match what you'd usually expect from a fund that focuses on innovative companies. Think of it this way. You're playing a video game, but you decide to change the game every 5 minutes. It may sound exciting or entertaining, but it can also be a bit all over the place and challenging to predict. To make it even clearer, consider this scenario. Imagine you're building a house of cards, but you keep changing the cards you're using. It can be entertaining to try different cards, but it increases the risk of your card tower collapsing. Similarly, ARKK's frequent changes in its investments can add a level of unpredictability and risk to your investment portfolio. Just remember that ARK has seen its peak in the previous years, but because of the changes, it has become more complex, so beginners should avoid this ETF, as its evolving portfolio and frequent trading habits might not align with a long-term investment strategy. Remember, investing should align with your goals and risk tolerance, so it's important to consider all factors carefully. Now finally, for the third worst ETF, we'll discuss AI-powered equity ETF. Its ticker is AIEQ. It is necessary to talk about this ETF as AI is gaining too much unnecessary hype. So, a beginner should have a clear understanding of the working and potential of AI-powered ETFs. AI ETFs are making headlines and everyone is talking about them. It does sound cool to have a robot assistant that can help you pick stocks and invest automatically. However, there's a twist. Just like ARKK, AIEQ also holds a reputation for excessive turnover, so it will bounce your investments quickly. This is a huge red flag for investors, especially those who are new to the game. But this is not the only red flag of AIEQ. Its AI system is also a limitation. Even if AI is as smart as it can be, it cannot make wise predictions just like us humans. It cannot judge properly whether the market will go up or down. It's a bit like trying to guess the weather. You can get close, but you can't always be right. So when an ETF like AIEQ changes its investments frequently, it's like relying on a weather app that keeps changing its forecast every hour. It can be confusing and may not lead to the best outcomes. To bring this concept closer to home, let's look at a real-life example. Imagine you have a smart home assistant that can control the temperature in your house. It's supposed to make your life easier by keeping your home at the perfect temperature. However, if it constantly adjusts the thermostat every few minutes, you'll find yourself feeling uncomfortable and perhaps even annoyed. Similarly, AIEQ's constant adjustments to its portfolio can leave investors feeling uneasy and uncertain about their investments. So, what should you consider if you're thinking about AI-managed ETFs like AIEQ? First, understand that while AI is incredibly intelligent, it's not a crystal ball that can predict the stock market's future perfectly. Second, be aware that excessive portfolio turnover can introduce more unpredictability into your investments. It's like riding a roller coaster that takes unexpected turns. It can be thrilling, but it can also be stomach-churning. Always remember that while AI is brilliant, it's not infallible, and there's no substitute for thoughtful and diversified investing. While the excitement of investing may make you excited to get quick returns, it's essential to understand that investing is a long-term game. You might not see profits for several months or even a year, which is entirely normal. It's crucial not to change your strategy hastily. Making money on day one or week one isn't how investing normally works. Moreover, instead of doubling down on investments that are performing well, I would warn you against the temptation to focus exclusively on winners. What's currently doing well might not continue to do so, and underperforming assets can bounce back. To mitigate risk, consider spreading your profits across various investments. Constantly monitoring your portfolio can lead to impulsive decisions. Successful investors often take a hands-off approach, making minimal changes to their strategy. To instill better investment habits, consider logging in only once a month or even less frequently to avoid unnecessary temptations. For beginners venturing into ETFs, caution is paramount. Selecting these funds demands careful consideration due to the varying levels of risk involved. A critical reminder is that diversification and a long-term investment approach are your allies. Spreading your investments and thinking about the future can help manage uncertainties and risks. Before jumping into any ETF, it's wise to seek professional advice or conduct thorough research. The investment landscape is vast and guidance is invaluable. In conclusion, these ETFs have their drawbacks. Remember that numerous other investment options are available for beginners. By staying informed and making prudent choices, you can embark on your investment journey with confidence and the potential for long-term success. Always keep in mind that investing can be exciting, but it's also important to be careful and think about the long term. Diversifying your investments, which means spreading your money out across different kinds of assets, can be a good strategy to reduce risk. So, keep an eye on these ETFs and do your research before jumping in. Happy investing!